Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
U.S. Treasury Secretary Janet Yellen acknowledged concerns from her counterparts in Japan and South Korea on exchange rates. The three discussed sharp declines recently in the Japanese yen and the South Korean won. Just this year, the yen has dropped about 9% and the won roughly 7% against the dollar. Before the meeting, the South Korean and Japanese officials had aired concerns about their currencies slumping to multi-year lows. South Korea and Japan warned of taking appropriate steps to counter any drastic volatility. Past G20 agreements have emphasized allowing markets to determine exchange rates, but they do leave the door open for action against excessive market volatility. Joining us in our studios in Hong Kong is Helen Zhu, Fung Trinity Managing Director and Chief Investment Officer, to take a closer look at markets. So, Helen, let me ask you this in as blunt a fashion as I can. Does a bull market really end because growth is strong?
I think the bull market typically ends either because the policy has inflected to the other side very hawkishly, or because, the growth is not good anymore, right? So when the growth is not good, that's probably the biggest threat to markets. At that point, even if the policy turns more dovish, people have skepticism. So weaker growth data from the U.S. is probably the bigger concern that we would have over just, the Fed, taking a little bit longer to cut rates.
Yeah, it's one of the things that a lot of Fed officials have been saying. I mean, they've been very stubborn in their unwillingness to kind of let go of this idea that higher for longer is what's necessary. But if you look at what the market is telling us right now, I was just doing a story on this the other day that Citigroup economists are looking for still 525 basis point rate cuts between now and the end of the year. And a lot of the traders in the Fed funds futures market are betting on aggressive cutting as well. Do you think the Fed runs the risk right now of a policy error maybe and not getting out in front of what we're seeing in terms of signs of economic weakness?
Well, I think the Fed has made it amply clear that their rate path is going to be more dependent on the inflation data rather than the growth data, right? They have a dual mandate. And at the moment, protecting growth is not really that vital compared to just making sure that the inflation side doesn't serve as a constraint. So I think so long as the inflation data starts to come off, they will jump off with the first rate cut. But how many they do subsequently, I think really depends on the path in the second half of this year. If you think back to last year, though, we had many ups and downs, right? People thinking that there were going to be, more rate hikes, less rate hikes, and the scare in the spring, and then everything looking great in the summer, and the scare again in the fall, and everything looking great again at the end of the year. I wouldn't rule out the possibility that the expectations regarding rate cuts, inflation, and growth continue to kind of jerk back and forth later on this year as well.
I just see them all as inputs. I'm a fan of math, so I look at equations. And basically, you think about it, with higher for longer rates, that's a potential negative for some companies because the costs will be up a little. But with growth stronger than thought, sales would be up. So net, that would feel a little bit like a standoff, a neutral. Yet the market is acting at the moment like it's net sell.
I would say you're right. In a strong growth scenario, so long as nominal is still going up and we actually have very robust growth, and I do think the markets, earnings and valuations and so on tend to do well. But I think the thing that we need to watch out for is really that people may start to worry about much bigger cracks, right? So we might actually have a scenario whereby the consumer, not necessarily because of where rates are today, but rather because of the fact that rates have held high for quite some time, and the refinancings at whichever levels of rates, 50 basis points lower than today or the current level, the refinancings from the fixed rates they had 3 or 4 years ago gets more painful. So it's more about time accruing and holding rates at a relatively higher level, whether 50 basis points lower or at the current level, rather than just the absolute level itself that makes a bigger difference.
One of the things we learned from the latest Beige Book survey, which was released today in the U.S., firms are reporting greater difficulty in passing on higher costs. Do you think margin pressure is something we really got to concern ourselves with?
I think margin pressure is, but you have to break it down between gross margin and operating margin, right? So gross margin probably responds more to things like, commodity costs and some of these things that are fluctuating more frequently. On the operating margin front, a lot of it is operating leverage, right? Fixed costs, et cetera. So sometimes a lot of the fixed costs can be amortized over a bigger revenue base, and that's what makes margins go up in the upcycle. And, things like wages or rents and those types of things are not likely to move as volatilely as some of the inputs into gross margin. So generally speaking, if inflation comes off and revenue doesn't grow as quickly, then you will tend to have margin pressure because you don't have as much operating leverage, or you may even have some operating deleverage.
So as you were saying in the answer to the first question, really it's a lot of this is about growth. If growth falls off and inflation is relatively high, then you have a major issue. In terms of canaries in the coal mine, the Dow Transports and the semiconductors are not trading very well here, down about 4% in a month. Now, 1 month is not a trend, and it's kind of in line with the correction in the S&P 500, off about 4 or 5% now after a big start to the year. Is it the start of something big, or really just too early to say?
I would say for things like the semiconductors, they have been just on a tear, right, over the last 6 to 12 months. And so it's not necessarily something fundamentals related, but probably just valuation and positioning and some profit taking that's quite obvious as a temptation after such a tremendous run. If you have something that's got the same earnings expectations as a month ago, but you're just talking about a difference between 80 times PE and 60 times PE, then people would rather sell that than sell something that's already gone down quite a lot or they haven't really made much money on. So I think it's probably more just coming from that rather than fundamental changes or inflection points at this time.
Helen, maybe we can talk about China for a spell here. That GDP print was pretty impressive, but if you look at the monthly activity data for March, it looks like things are softening a bit. I mean, how are you reading the Chinese economy right now?
Well, I think that you probably saw a couple of brokerages have actually upgraded their GDP forecast for this year from, let's say, mid to high fours to like closer to high fours to 5%. So previously people are very, very skeptical, but recently we've started to see some more promising data, as you mentioned, coming out of the destocking period in December, January, and kind of coming more back into a restocking period. So I would say net, we're not really completely out of the woods, but certainly things look to have landed to some extent, and maybe there are some slight mild surprises. Of course, the market's going to be most worried about what happens in the latter part of the year, towards the end of the year, or maybe beginning of next year, depending on what happens on the tariff and geopolitical side post the election. That's probably the biggest overhang on this economic L-shaped landing story.
So putting the CIO hat on for a moment, what looks the best at the moment in terms of new capital?
Well, we think that things are probably in a Goldilocks and no landing and, some rate cuts plus no economic weakness type of mindset in the U.S. Bond yields have popped quite a lot recently because of the concerns about one or two inflation prints, which really resulted, for example, the March inflation print pop was really because of auto insurance and some very idiosyncratic narrow categories that we don't know whether they're going to change in the next couple of months. So we actually think that we would find Treasury to be more attractive at the 4.5, 4.6 level on the 10-year versus what we have seen in quite a while. So some of that might be a lot more interesting versus last couple of years. And then we also think that hedging is quite attractive. Really, vol is pretty low and cheap at the moment, so hedge the sections of the economy that have performed well. With the DXY reaching 106, we think we're probably getting closer to a dollar peak, and all the segments like Asia emerging market equities and local currency bonds that have been crushed by the dollar, we think those are looking more interesting.
Well, it's interesting you make that point because I was going to ask you about the comments that we had from Treasury Secretary Yellen speaking with finance ministers of Japan and South Korea about the depreciation of both the yen and the won as the result of a stronger dollar. And you feel as though the dollar has put in kind of a near-term top here and you're not expecting much more in the way of strength. Is that right?
I think unless there is a massive multi-month CPI, inflation upside surprise. I think the dollar's basically got to, the peak of this mini cycle. And I would agree that it's really the Fed and what's happening in the U.S. that's swinging currencies around more than whatever the BOJ or Bank of Korea are doing.
Yeah, and with these yields this high, you've got to worry about asset allocators coming in and just, they're picking off 5%. They like that. Over 10 years, it's something that could disrupt equity pricing, right?
That's right. That's right.
Thank you very much for coming into our studios. Helen Zhu, Fung, Trinity, a Managing Director and Chief Investment Officer.
Today, President Biden vowed to keep US Steel a totally American company. He made that pledge during a speech to the United Steelworkers in Pittsburgh. Let's take a closer look now with Laura Davison, who is Bloomberg Politics Deputy Team Leader. She joins us from just outside Washington, D.C. Thanks for taking time to chat with us, Laura. I'm wondering, I know that the union is so strongly opposed against the bid by Nippon Steel to acquire US Steel. Obviously, Pennsylvania is a big player in that. It's a swing state for Biden. Do you think this has the potential to go through after the election? Is this merely kind of an election ploy on the part of the president?
It has the possibility to go through, but when you think about that both Trump and Biden are opposed to this deal, so, effectively, no matter who wins, the president is likely to be opposed to the deal. That really has the potential to really put the brakes on this. We mentioned, Pennsylvania is a swing state. It could be one of the states that decides this election. And it is, for Joe Biden, it is his home state. He was born there. You really saw him in his element today, that there is, really not a lot of love, both within the union community as well as the broader U.S. community for this deal with Nippon Steel.
Critics would say that more steel tariffs is really just brazen politicking. I'm tougher on China. No, I'm tougher on China. No, I'm tougher on China.
Yes, this is really what you're seeing happen. Both Trump and Biden, they disagree on a lot, but tariffs on China and specifically tariffs on steel from China are one area where they really agree. The tariffs that Biden announced today as part of this trip, tripling some tariffs on metal from China, are really symbolic. The tariffs that Trump put in place are so high that really imports have ground to a halt from Chinese steel coming into the U.S. But this is really a way for him to message and signal to voters, look, I am serious about, made in America, keeping union jobs here. But this is kind of, you're really starting to see the transition from, the White House working on, serious policy to policies that they know that they can take to the campaign trail.
When I think of issues like the border, when I think of the abortion issue, and then I consider industrial policy, it doesn't seem like it's going to be up there on the list of pressing concerns during this election season. Am I right or wrong?
That is true, and we've seen time and time again, things like the infrastructure package, things like the CHIPS Act, are not issues that voters are really thinking about, but they are thinking about things like jobs and inflation, and those are the kinds of things that at least the White House says, are helped by some of these policies, by having semiconductors made here, although they're not, they're very far away from still being made in the U.S. with these new fabs that are being announced, that they're kind of hoping to get ahead of that and saying, look, we're setting the U.S. up to sort of renew its industrial might. But this is a real big gamble for the White House because they're seeing in poll after poll that voters aren't really registering. They called this whole program Bidenomics. It didn't really land with voters. So now they're having to rethink their strategy on, how do you talk about both the economy as well as abortion, which is where you've really seen Democrats in the past 2 or 3 weeks pivot to having that be their central campaign issue.
Laura, what do we know about the U.S. and this probe on China's shipbuilding industry? It's actually more. It's kind of a full gamut of maritime industry, including logistics and other aspects. So what do we know about that?
Yeah, so this will be a pretty comprehensive study. We've already seen, in the Chinese response to this from the Commerce Ministry earlier today with a very stern rebuke on this, saying it was not necessary. And so that's where you really see kind of the, it's a little bit under the water, so to speak. The tariffs are kind of the big headline thing, but this, review could be more where there's actual, kind of economic power and sort of an economic hurt that goes from Washington to China.
One of the things that we were talking about earlier in the program is the fact that this ByteDance bill, the TikTok bill, is going to be moving through the Senate very soon. The president's still committed to the idea that he would sign this bill and potentially force ByteDance to divest ownership of TikTok or ban it outright. Do you have a sense of how this is going to play out over the next couple of weeks?
Yeah, this is really a fast-moving bill that Speaker Johnson, a Republican in the House, is looking to move, potentially as soon as this weekend. This is, really, it's got bipartisan support, and it's been a bill that has been out there and has been floundering, but as of right now, it looks to have the support to pass. I will note that Congress is a, infamously fickle place where last-minute deals get cut all the time. But right now, this bill is set up for a vote, and no one should discount the fact that this could become U.S. law, in the next couple of weeks.
I guess one aspect of the TikTok information in that bill is that it's one company, and it's kind of unusual to come up with a law that targets one company. And I think Maria Cantwell raised the idea of having, a lot of judicial action targeting this. Well, what are the sorts of claims that would come perhaps from the Chinese side on that?
Yeah, so there's a lot of concern, both from the Chinese side as well as you noted, from the U.S. side here, that this is targeting one specific company, and that this, is almost certain to be mired in appeals and judicial reviews. That there should be some sort of standard that would apply to any social media platform, whether it's ByteDance and TikTok or something else that should come to the future. So we're not just reactively legislating, but instead looking at sort of what is the standard we want and having things meet or fall short of that.
Laura, thank you so much for being with us. We covered a lot of ground there with Laura Davison, Bloomberg Politics Deputy Team Leader, joining us from Washington.
We thought we would take a closer look now at the trials and tribulations of policymakers in China. Joining us on the show is Lillian Li, Vice President, Senior Credit Officer at Moody's Ratings. Lillian, thank you for joining us. It would seem at the moment China is caught in the middle a little bit between looking at the long-term drivers of growth and tinkering with that versus the need to do something in the short term in the way of short-term cyclical stimulus for the economy. How would you say it's managing that balance at the moment?
Yeah, thanks for the questions. So right now we see that the Q1's China's GDP growth actually beats market expectations, range up to 5.3%. That is largely driven by those supply side measures from the governments, as well as the export sectors showing quite delightful pictures because of the global resilient demand. But however, how sustainable would this effect from supply side measures is uncertain. So we see that China is facing its structural long-term challenges, now including, for example, some of the imbalances in its supply and demand in some sectors, and fiscal imbalance between central and local government, as well as the low productivity growth. So how could they balance these challenges in short term and long term? While these policy settings is key things for the government to drive its growth potential. So actually, the contributions from its new growth drivers like new EVs, renewable energies, their contributions to GDP cannot match those old engines like property and infrastructure. And then the over-reliance on some of the government support for these new sectors could lead to potentially some overcapacities and price distortions. As well, the short-term challenges and long-term structural factors, risks could both require significant focus and expenditure from the government. So that's really a tricky thing. How would they balance the shift? That really needs coordinated policy approach as well as consistent policy directions to implement its policy measures already announced.
Lillian, I'm very curious as to whether or not in your work you look at debt to GDP and whether that ratio is important to you. I was struck today by the fact that the IMF was saying that China and the U.S. will together drive much of the increase in global public debt over the next 5 years. And this is the IMF, the analysts there, projecting that public debt in both China and the U.S. under current policies will nearly double by 2053. Are you concerned about the high debt levels that you're seeing? Let's stay focused on China. Is that a concern for you?
Yeah, indeed. Actually, the elevated debt as well as the rising debt servicing cost are the major challenges for the government fiscal to constrain their fiscal capacity to support growth. It is one major concern from our ratings on to evaluate China's sovereign credit, and that's actually exactly one major drivers of we changing the outlook to negative last November. And going forward, as I mentioned just now, the government continue to face the balance between long-term and low and short-term growth target. In that sense, the capacity could be more constrained if they are continue to face this elevated debt. But right now, the local government has limited fiscal strength to support growth. So in that sense, the central government is trying to shift some of the burdens to the central government's balance sheet. So that could be some way to help mitigate some of the burdens on local governments and trying to make the transition period a little bit more comfortable for the local government to continue to support growth. Yeah.
Households are under stress, and it's in part because the social support system in China is not so well advanced. I mean, there's so many things that are so far advanced in China, but in terms of the average person feeling comfortable about his or her retirement, about medical needs, unemployment insurance and these types of things, is there a lot that China can do on that front? I know it takes time, but should they be doing it?
Well, on this point, I need to say that the government spending on social security actually has kept increasing in the past couple of years, and that has been reflected by its pension, healthcare per capita spending. So you could see, from my personal view, I could see a quite noticeable improvement on this front. But however, of course, they should have been doing more to further promote this quality of services, especially though in some of the lower tier cities and remote areas as well as rural areas, that could help to release more of the consumption powers from their savings. Yeah. So in that sense, I would say that the government should continue to do what they are doing right now already. So on the other hand, as I mentioned before, there could be a constraint from their fiscal balance sheet because they need to still support growth from like investment in infrastructure. That could be probably showing more on the GDP growth numbers. Yeah.
Lillian, thank you very much for joining us. Lillian Li, Vice President and Senior Credit Officer at Moody's Ratings.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.